6th. April 6th, right? So, we're going to talk about some governmental accounting. We're going to talk about fiduciary funds. I'm trying to be very brief today. And we'll come back on Wednesday and we're going to do some of the journal entries. So I just want to kind of gloss over the topics in Chapter 8. I want you to try to, before Wednesday, have the Learn Smart complete. That way you'll have a better grasp of the concepts that I'm talking about today by then, okay? Before we start, though, I want to do a quick little devotion, nice and easy. This is from Tucker White. He lives in Pennsylvania. And the name of this devotion is called An Unshakable House, okay? An Unshakable House. This is how it reads. I've spent all of my life in Pennsylvania. Almost every breath I've taken has been of Pennsylvania air. The cool breeze that came when the weather was hot was recognizably Pennsylvanian. Don't ask me how I knew, but I did. This place was my home. But now I'm far away. I've left Pennsylvania for college, and this air isn't the air I know. Familiar brands aren't as prevalent here. People act differently, and the mention Philly cheesesteak, they mention Philly cheesesteaks as if they are some exotic, semi-exotic cuisine. This is not my house. These are not my people. But God has remained the same. No matter the location, no matter the culture, no matter the people, God is steadfast. The Holy Spirit has surrounded me. I know my home is where the Holy One resides, and that's anywhere. All right, so very good. That was from Tucker White again from Pennsylvania. One person in our class might think that's quite enjoyable, being from that area, right? We'll leave it at that. So, Chapter 8 is dealing with fiduciary funds. Fiduciary funds are fiduciary activities, fiduciary funds. And you see here on the screen, let me make my head a little smaller here. And you see it here in the 1, 2, 3 bullet points. Determining if a fiduciary fund exists. That's these 3 bullet points right here, okay? And let's make them yellow. The assets related to the activities are controlled by the government. 3 general criteria for determining if their relationships are the assets related to the activity are controlled by the government. The assets related to the activity were not generated by the government's exchange or non-exchange revenues. And then here's the big kicker here, number 3. The government does not benefit from the assets, okay? So the government's controlling the activity. It is not money that the government generated, and the beneficiary is not the government, okay? I'll try to explain it once we get to some of these tax funds here shortly. All right, so there's 4 fiduciary funds, okay? And that's going to be your question number 1, is to list the 4 fiduciary fund types, all right? So the first one is custodial funds, okay? We'll bounce back to it in a minute. Then you've got your trust funds. Now this is there's multiple in here, okay? So you've got investment trust funds. That's number 2. Number 3 is private purpose trust funds. And number 4 is escaping me right now. Let's find it real quick. Pension trust. Okay, we did that one, right? So, that's the last one. Pension trust funds. Okay, now that's got a much larger name. You'll see it in a second, but pension trust funds is enough. So we got custodial funds. This is the answer to your first question for the week. The 4 fiduciary funds are custodial funds, pension trust funds, investment trust funds, and then private purpose trust funds. Okay, let's go back. So custodial. So when you see custodial, the definition's pretty, it's kind of silly. Let me find it real quick. Yeah. So custodial funds are fiduciary funds that are not one of the 3 types of trust funds. I hate those type of definitions, right? So if it's not investment trust, pension trust, What's the other one? I just forgot it. Let's find it again. Private purpose. Okay, there we go. If it's not one of those three, if it's not private purpose, investment, or pension, then it is by default a custodial fund. So it's kind of that catch-all, okay? Within here, there's 3 subtopics. The one I'm going to spend the most time on, pretty much all my time on, is going to be the tax custodial fund. And this is the easiest one to explain as well. So here's the custodial funds for special assessment debt service. Let me try to explain it very briefly, okay? We had this in a previous chapter. We talked about a special assessment. I think it was maybe in the tax levy section. But in that example, the government was like a co-signer. So if the special assessment wasn't collected, then the government had to foot the bill. When you have it in this situation here, a special assessment, the government is not responsible for default, okay? An example, if I can come up with one, I guess if a neighborhood came together and got the city to levy a special assessment tax on the people that live within in that area. Maybe it's, they'd be taxed onto their city tax for the year, and they would use that money to maybe put in like a playground, okay? That could be handled through a custodial fund, assuming the government doesn't have to pay for it if the if the neighborhood were somehow to default. So what you would see there is the city is collecting taxes from the homeowners that live in that neighborhood. They're putting that money aside. They're investing it temporarily, and then whenever it's time for a debt payment, they send that money to the debt collection function. Okay. So that would be your custodial fund. The big thing there is that the government does not have any liability if there's a default. Okay, so that's the first one. The second one here is the tax custodial fund. Okay. Now, you can kind of get a grip on this topic when you just think about a business, okay? Let's say you have a clothing store, nice and easy. And, when you operate in, Greenville County, I don't think there's any sort of subsidiary tax in Greenville County. Maybe there might be. But the state sales tax in South Carolina is 6%, okay? So if you sell a shirt for $10 at your retail store, you're going to charge the customer $10.60. That's very easy math, right? That 60 cents is a liability to us, to the business. We have to send it to the state later. So when we're holding that, what a good business should do more or less would be to take that 60 cents and put it into a separate account. Because it's not really ours, we don't want to spend it. And then once it accumulates at the end of the quarter, we will transmit that money to Columbia, right, for as a quarterly tax payment. And so, kind of the business is kind of as a fiduciary of that money until it goes to Columbia. But that's not really what I want to talk about here. So let's be a little more specific. I've got some actual numbers here from, I live in Spartanburg County, so we'll talk about that. Let's say you go to McDonald's, okay, and you buy a dollar sweet tea, and I think there's still $1, and you hold out your dollar bill. You're like, all right, here you go, I'm ready for my sweet tea. They're like, whoa, it's not $1, it's $1.09, right? Like 9. Where do you get 9 from? It's 6% sales tax, and so that's this. I got on my little board here, okay. So the South Carolina sales tax is indeed 6%, okay? And Spartanburg County has a 1%, it's some sort of a capital projects assessment that's tacked on to the sales tax. And then whenever you're talking about prepared food, it also deals with alcohol, drinks as well, alcoholic sales. They get what they call a hospitality tax, okay? And so that's the 9 cents right there, is that 9%. So 6% belongs to Columbia, 1% belongs to the Spartanburg County, and that 2% goes to the hospitality tax. It's often called hospitality and accommodations tax, which is used in the state government as well. All right. So, whenever McDonald's transmits that money to Colombia, that's when the fiduciary relationship really kind of begins, because that, and I'm talking about the 3% there, the 1% to Spartanburg, and the 2% for the hospitality tax. Once the 9% gets to Colombia, at that point, that 3% is like a fiduciary. The state has a fiduciary responsibility to keep up with, and so that's what's going to happen. So the tax custodial fund is what we're talking about. Let's see what it says here. A custodial relationship that often results in the creation of a custodial fund is a collection of taxes or other revenues by one government for several of its funds it operates for other governments. State governments commonly collect sales taxes, gasoline taxes, and many other taxes like that hospitality tax that are apportioned to state agencies and to local governments within the state. Okay? So that's kind of what we're talking about here. Again, like that 9%, 3% is not for the operations of the state of South Carolina. Instead, it's for Spartanburg and that hospitality tax. I didn't research what it's used for. I used to know, and I just would have to kind of look back into it. Anyway, so let's keep going, okay? Because I don't want to spend too much time on any one topic. I want you guys to go through Learn Smart. But when we do our journal entries, they're going to be on tax custodial funds. So we'll come back to that pretty heavily. All right, there is another in the custodial fund that's kind of gets some airtime as well in the book, which is, where's that? Pass through custodial funds. It says here, grants, entitlements, and other shared revenues from the federal government or a state government often pass through one level before distribution to a secondary or sub-recipient. The accounting for such pass-through grants depends on whether the primary recipient government is deemed to have administrative involvement or direct financial involvement in the grants. Okay, so sometimes we'll use these pass-through custodial funds. Usually it's the money's coming in and it's going right out. So there's not a whole lot to them. So within the custodial funds area, there are three little subsets the book likes to talk about. The first one being the special assessments. Where's that first one up here? Way up here, okay. Special assessment debt service. And then you've got tax custodial funds. And then finally the pass-through custodial funds. So that's the custodial funds of those three parts. Now let's go ahead and look a little bit closer at the trust funds. Especially we got the investment and the private purpose trust funds. Okay, it does talk about these investment pools. It's common for governments to possess both long-term and short-term investments as well as idle cash within their funds. Effective management of investments can be enhanced by placing the investments of funds in a pool under the control of the treasurer or a professional investment manager, either within the treasurer's office or in a financial institution such as a bank or investment firm. Okay, so if we have this pool of investments, then you'll have other. If it's available for all the other funds, then if they have idle cash, they can invest that idle cash into the investment pool. And when they take it out, they'll get their money back plus some extra from the earnings and the investments made. So that's essentially what's going on here. You'll have what does it say here? There are some journal entries. There's a problem that we're going to talk a little bit about too. So let's just wait for that and do it then. But what you'll have is several, like this right here, right? So this debt service fund. So these different funds pooled in their money and have an investment investment trust fund worth $47 million. You see how it is divided up amongst the different funds. We got the debt service fund, capital projects fund. You got the city of Washington, that would be like the general fund. And then the Washington School District, it's a special purpose government, right? So that would be is in there as well. And so this would be their stake in the investment. Hopefully it's going to be growing. Now if they started it in mid-January, and where we are right now, they're probably in the red, but that's because of the craziness going on in the market right now. Of course, if they bought like treasury bills and just CDs that are guaranteed money, then that wouldn't be a problem. But anyway, so these you see here how we got they pool the money up. So sometimes you'll see like it's a pool of assets, or not a pool of assets, but a pool of investments. Okay, and as you withdraw from there, you'll get your increased amount based on the appreciation of that fund. Okay, private purpose trust funds. Individuals may or organizations may establish trust agreements to confer assets to another party at the present time or a future date. The fair value of assets placed in trust is referred to as the principal or the corpus. If the principal of the trust fund must be held intact, it will be called an endowment. Okay, but typically, what you have here with these private purpose trust funds, the principal is typically non-spendable, but usually the income is. So a good example here would be something like a police officer's, I think it's in the book somewhere, like a police officer's education fund where you can donate to the police officers, and it goes into a non-spendable principal amount, and as it earns earnings, they take the money out of there to give scholarships to students whose parents are police officers. And so that would be a good example of a private purpose trust fund. The reason it's private purpose is because the recipients, in this case would be the students of police officers, are not government employees. They're outside of the government, so that's why it's private purpose. If it would be like a public purpose trust fund, like if it was for the employees to go to school, then, or the police officers to go to school, then it wouldn't even be a private purpose trust fund. It'd be a public purpose trust fund, and you could handle that in just a regular special revenue fund. So it has to be an outside entity that's receiving the benefits. Okay, they got to be outside of the government, or at least outside. There could be another government, but as long as it's a separate government, that'd be getting the benefits. All right, and then finally, the pension trust fund is kind of just what you think. Okay, this is going to have a lot of accounting going on here. You've got your employer contributions, you got your employee contributions. There might be some fairly complicated calculations that take into account the salary of the employee. They get a percentage of that guaranteed after they retire, or it could be an amount that's calculated on some sort of a based on the age, and it's in here. It's under the defined benefit plans. Here it is. Provides a specific amount of benefits to a retiree based on a formula that may include factors such as age, salary, and years of employment. Okay, so there are these two different types of plans. I'll let you study those personally. They're not very difficult. I don't even think we have much in the chapter on them. It's probably on the Learn Smart somewhere. So refer to these two blue marks whenever you read those real quick, and you'll be in a good spot. All right. So at this point, I just want to. Okay, there are a couple of statements that we do: fiduciary net position and fiduciary changes in fiduciary net position. So this is kind of like balance sheet. Can't really call it a balance sheet. And then the statement that changes is like the kind of like the income statement, where it shows if it went up or down from year to year. So that's going to be our two primary financial statements, and they would be included in the CAFR, the comprehensive annual report. but they will not be involved in they're not a part of the government-wide statements because it's not government-wide resources. They're for somebody else, which makes it a little bit easier at least. It doesn't have these don't have to be included in the consolidation of the government-wide statements. Okay, so real quick, I've got let's do just a quick multiple choices that are in the EOC, and then we'll come back on Wednesday. We'll do the journal entries that are in there. There's a couple problems that we're going to look at. Yeah, chapter 8. So let's do these real quick. There's like 6 or 7. I don't have very many in here. Let's see. So here's our first one. Which of the following helps identify the existence of a fiduciary relationship? Okay. And here it's going to be... Okay, look at the answers real quick. You have a choice. So what it boils down to is the assets are for the benefit of individuals or entities that are not a part of the reporting entity. So that's going to be the correct answer here. Remember, the reporting entity does control the assets, okay, but we don't control the benefits, okay, and that's where that one is. Okay, so check my work. Okay, score that one. All right, number 2, which is not a not a fiduciary fund, okay? Remember, there's 4 answers. This is your question for the week as well. You've got 3 of them on here. You've got custodial fund, investment trust fund, private purpose fund. The 4th one is pension trust fund. And instead, we got permanent fund, which is one of our 5 governmental funds, okay? So that's the wrong answer. So we'll score that one. See, it's correct. Number 3, excuse me, which of the following is an example of a trust fund, okay? So not custodial, but one of the 3 trust funds, which is those 3 trust funds: pension trust, investment trust, private purpose trust, okay? So let's see what we got. The fund itself, a fund used to account for the collection and distribution of taxes to several governments. We just talked about that, right? That's the tax custodial fund, so it's not that one. Okay, what we got here? A fund used to distribute scholarships to the children. Here we go. I gave the answer away, right? These children are on the outside of the government. Okay, so that would be a private purpose trust fund. So that's going to be our answer. Let's look at the other 2, though. A fund that used to account for gasoline taxes for road maintenance. That's going to be another tax custodial fund. And this last one down here, a fund used to account for risk management services provided to other funds of the administering government. That to me sounds like what's that thing called? Internal service fund, okay? So that would not be right either. All right, number 4, fiduciary fund activities are not included in the government-wide statements, and it's kind of like why, right? Because the resources in the fund are not owned by the government. Well, we do actually control the resources, so that doesn't sound very good. Or does it? We'll come back to that. Unless the government has an interest in the fund activities. If there is no fund, it is this first one actually. Because the resources in the fund are not owned by the government. Well, that makes sense now. So we have control over the resources. We just don't own the resources. That's what it is. I got off track for a second. Okay, so there'll be that one. Let's see what it says. No further explanation. I could use a further explanation. Tax custodial funds. Okay, we discussed this already. Collect the taxes, you hold them, and then at some point you're going to transfer them out to where they need to go, right? So while you're holding them, that's where you're being a custodian, or even the word we like to use a lot of NGOs, because you're being a steward of somebody else's money. And so we got to make sure it's taken care of properly. Tax custodial funds are required to account for a government's collection and remittance of federal and state payroll taxes. Well, the federal one goes straight to the... let me think about that one a minute. Number 2, are used by a county assessor to compute the amount of taxes due. Now, that's not right. are used to account for the collection and distribution of taxes when one government collects taxes for multiple funds and governments. That one sounds really good. And are not allowed to charge for services rendered to various governments, governmental funds or other funds. I don't know about that one. So it looks like right here's going to be our answer. So up here are required to account for the collection and remittance of federal and state payroll taxes. That would just, if we were in a general fund, when we remit federal taxes, it would just go straight to Washington, D.C. It might not be Washington, D.C., but wherever the Treasury is that's collecting them. And then the state payroll taxes would go straight to Columbia. We wouldn't have some sort of a fiduciary fund for that. We just have a due to federal and due to state. So check my work. And I think one more. Fiduciary funds. Okay. And I didn't cover this, but we can cover some of them Wednesday when we come back. And it is the fiduciary funds. What we got here? Cannot recognize investment gains until the investments are sold. Okay, that's not true. We can do a net realizable value thing. Include trust, custodial. Oh, there's that permanent fund again. That's not right. Number 3, this is the third one down here, are not included in the CAFR because they account for assets down by the government. They are included in the CAFR, just not in the government-wide statements. And so this is top one here. This is what I want to point out. These actually use the accrual basis, not that modified accrual. So hopefully the entries will be a little bit easier than you might be thinking, okay? Which is good. And now that's going to get us to our problem. And then we're going to go ahead and stop here. We'll come back on Wednesday. We'll do 7, 8, 9. And between now and then, please try to take the time and get the Learn Smart completed, okay? So have a good 2 days, and we will see you Wednesday, and we'll finish this up. And once I get it finished up, I'll get we got to do 2 things coming up here. We got to do, excuse me, unit, we got to do a Chapter 8 quiz and a Unit 4 assignment, okay? I'll get those prepared up for you so you can have them on Wednesday. I'll probably give you a couple extra days to finish the assignment into next week, okay? All right, guys, you'll have a good 2 days, and we'll see you then. Blessings to you, and we'll see you on Wednesday.